Hey, what's up, guys? It is Tuesday, the 29th. I'm going on round two at this recording thing here today, just because a lot of data that I was looking at, switching from screen to screen. The last one lost the screen and got a little frustrated. So I'm going to give this a second run. So what I am seeing out there in the market, a lot of stuff to digest. The market itself, as far as home prices, that has actually, really surprising. I'm looking at the FHFA housing price index, and they showed the month over month from March of this year to April of this year. And then, of course, April of 2020 to April 2021. And we're seeing that nationally, we've got a 1.8% increase month over month from March to April. And then we're showing a 15.7 national increase April to April. So April 2020 till April 2021. But really interesting to see is the one area that's leading everything is the area I'm in, the mountain region. That region is growing 2.6% in home prices month over month and 20.6% in home prices year over year. Everybody else, we're looking at the Texas area and those surrounding areas about 13.2% year over year. Somewhere in the South, the central part of the South, 14.8%. The South Atlantic, your Floridas, your Carolinas, you're talking 16%, New England, 18%, Middle Atlantic, 16.3. I can go on and on and on, but nothing is really pushing like the mountain region. So kind of interesting to see what's going on there. So a lot of people pushing over in that particular area of the world. Interest rates are low, prices keep jumping up. And I think a lot of it's just fear of missing out. That fear of missing out is causing a lot of people to go and jump into purchasing when in reality, it may be something better for them to wait. I can't say. I don't know. A lot of people keep asking me, what's going to happen within the market, where are things going to go? And man, I close my eyes and throw darts. I have no clue. There's nothing out there to tell us what we're going to deal with here, just because we've never seen this before. I'm also trying a new service when it comes to the being able to show the charts. And so I'm going to check this out and see how this one works for me, but I'll show you what this looks like. At least now I've got a dashboard that I'm working off of that's going to give me a lot more information to see all at once. I always like to watch the the UMBS 3.0 coupon, what I like to look at. That's the closest to being able to gauge where things are going for real estate investors. So that's what I'm going to be watching here. What's driving the bonds today? And I'll show you a different chart here that I can mark up and play with a little bit. It's just a matter of me finding the chart. So this one here, a little bit more detailed. I can play with it a little bit, put some marks on. So what I did is I drew a couple lines here. These are not that exact of where things are heading, but it's showing there's a little bit of a squeeze coming. We got this the trend line. If it starts even up here, and then of course you got where things are trending upward. They're going to squeeze into this point, and then they're going to decide where we're going to go up, we're going to go down, where things are going to head from there. You would think that we're driving hard to that direction. I thought we'd have probably pushed a little bit further up today, just because there's a lot of news that came out very, very recently. That's big bond-friendly news. Personal income is down, personal spending down to almost negligible. Consumer sentiment completely gone, right? People are not aggressively. It's interesting enough, they are aggressively buying, but they're not to the extent that they'd expect. So all those things are very bond friendly, because it's saying that our market's really not as strong as it's being led. We're being led to believe when you're looking at the economy as a whole. And when you're talking about the economy being stronger, you would have people. You would see a lot of those things being readings a lot higher, therefore saying the economy is a lot better shape, therefore more bullish for the stocks and more bearish for the bonds. Well, right now we're in a position, it seems like would be a lot more of a bearish, bullish world for the stocks, but for the bonds, but we're not seeing it. So what that basically says is that the traders like the pricing where it is. Now, I would imagine if it continues like this, we might see that continued bond-friendly news push these mortgage-backed securities into a better position, possibly lower rates. It's kind of hard to say. I can imagine that lower rates are available after what we've experienced, but you never know. It's kind of hard to say what the market is. I would not bet on it right now. We know from the information we provided. If you don't have the app yet, it's coming out soon. Be able to go over that on one of these videos and show that even with the Fed's form of inflation, we start looking at what they're measuring right now, and we'll go over that when I've got the app available to go over. Just plugging in what the Fed says the inflation is, you're barely paying just above what you've borrowed over that 30 years. So back to what we always talk about, leverage high, leverage long, pay off slow. We'll get you more information as it comes out. Thank you, guys.